Communications and Multimedia Minister Tan Sri Anwar Musa says 6 local telcos have agreed to take up the stake offered in Finance Ministry-owned Digital Nasional Bhd or DNB, ahead of today's deadline for them to finalise the decision. Anwar said a 70% stake in DNB will be split between these operators and that everything will be concluded by next week, with an official announcement to be made then. He also shared that everything is according to plan and issues pertaining to transparency and pricing have been ironed out. DNB is the special purpose vehicle set up by the government to roll out and own the 5G network infrastructure nationwide. Yesterday, Singapore Straits Times reported that a non-binding term sheet had been agreed upon by 6 telcos, along with a shareholders' agreement to take up a stake in DNB, which is expected to be signed early next month. It said the 6 telcos, including Celcom Axiata, Digi.com, Maxis and U Mobile, will take up equal shares in DNB. Mr. DIY Group Malaysia says that while the group is trying to maintain the low prices of its products, it still may have to raise prices in the future due to inflation. The home improvement retailer's CEO Adrian Ong said the group's intense focus is to stay true to its values about always low prices, but conceded that there are situations where it will have to make price adjustments. He gave his assurance that any price hikes will be done in a very responsible way and only to the extent that it cannot continue to keep supplier costs low. Mr. DIY Group was previously reported to have raised product prices in April and May. Ong explained the group offsets increases in costs by managing supply volume and emphasizing operational efficiency. Its ability to purchase in very large volumes allows it to negotiate good terms with suppliers and keep prices down. Ong was speaking at the official opening of the group's first Mr. DIY Plus store in Mid-Valley Megamall, Kuala Lumpur. The 30,000 square foot outlet brings its total number of stores to over 950. It aims to open 180 new stores across all its brands this year. Mr. DIY shares were up 0.98% at RM2.07 at the close, giving the group a market capitalisation of RM19.51 billion. Bank Negara Malaysia or BNM says Malaysia's banking system remains well capitalised to support economic recovery. It said capital ratios rose marginally in May, driven by valuation gains on available for sale financial instruments as bond yields eased temporarily during the period. It said in its monthly highlights for May report today that the domestic banking system recorded RM121.5 billion in excess capital buffers as at the end of the month under review. Overall gross and net impaired loans ratios remained broadly stable at 1.6% and 1% respectively, reflecting the marginal increase in impairments from the business and household segments following the tapering of repayment assistance measures since the first quarter of 2022. Total provisions remained at a prudent level, accounting for 1.8% of total banking system loans and 109.1% of impaired loans. As of end May, total provisions and regulatory reserves stood at RM40.7 billion against RM40.2 billion as of end April. On the domestic financial market, the central bank said market adjustments remained orderly, following a decrease in May in the 10-year Malaysian government securities yield by 21 basis points, supported by foreign portfolio inflows into the domestic bond market. In contrast, regional bond yields rose by 24.5 basis points on average. It said the local financial market was also driven by tighter global financial conditions due to expectations of faster and larger policy rate hikes by advanced economies. Country Heights Holdings is allocating RM100 million in capital expenditure to expand and strengthen its wellness business segment, one of the group's top-performing pillars during the COVID-19 pandemic. Founder and major shareholder Tan Sri Lee Kim Yew said the government has been championing medical tourism before COVID-19 and had done very well in this segment even during the pandemic. The group's subsidiary GHHS Healthcare booked a profit of 3.23 million ringgit in 2021 on a turnover of 26.72 million ringgit. Lee said there is huge potential in this segment and the group is aiming to grow it by 3 or 4 times by repositioning its group wellness business as a new branch of wellness tourism, which is a bigger market compared to medical tourism. He said if one were to consider the spa, rehabilitation and aesthetic business, there is a much bigger market because clients may require a longer time to recuperate. Lim added that the wellness division will expand into a new building this year, with a traditional Chinese medicine hospital targeted to be launched in the second half of the year and a confinement centre targeted in 2023. Reach Energy will issue 1.03 billion new shares at an issue price of 20 cents apiece to offset debt owing to Super Racer amounting to $49.56 million or 206.51 million ringgit. Super Racer will be the largest shareholder of the group following the exercise, with a stake of 48.5%. The company said it plans to seek exemption from making a mandatory takeover offer of Reach Energy's remaining shares and outstanding warrants. The share issuance will nearly double Reach Energy's existing share capital of 1.1 billion shares and would bring its enlarged share capital to 2.13 billion shares. It will also dilute the stake held by Reach Energy MD Shahul Hamid Muhammad Ismail via Reach Energy Holdings to 6% from 11.66% and MTD Capital's stake to 5.38% from 10.45%. Super Racer is wholly owned by a Hong Kong citizen, Cheong Siu Fai, a former head of Asia Pacific of the Strategic Equity Solutions of Merrill Lynch Asia Pacific. Cheong is also the founder of Hammer Capital Group. The issue price of 20 cents apiece is more than triple Reach Energy's last trading share price of 5.5 cents. Subsequently, Reach Energy also intends to enter into a shareholder loan facility agreement with Super Racer for a loan facility of up to $5 million or 22.01 million ringgit, mainly for working capital purposes.